Greetings. One of the subtopics I want to start up on this channel is some more nuts and bolts of investing strategy because I have a long track record of success in that. I've run a successful hedge fund and have a lot of years in investment banking. And at some point I'll discuss my hedge fund returns as well. Now, the situation that we're facing right now is one where a certain number of classical stock market indicators are all signaling one thing, which is very bearish. Bearish means we think things are going to go down. Bullish, of course, means that we think the market is going to go up. And I will detail a couple of those. Now, before we do that, let me show you just one of the many time-stamped accurate predictions that I have. This is a tweet that I made on the Twitter platform. And this was on March 22nd, 2020, so in the midst of that very steep COVID-19 market crash. I said the exact stock market bottom is impossible to call, but the S&P 500 at 2250 or lower from this point on is one of the best entry points you'll ever see in your lifetimes. Trillions of dollars of QE have been done worldwide, read the Atom publication, and this turned out to be correct. 2250 or lower in March 2020 was just about the best entry point anyone could ever see in their lifetimes, and you will probably never get something that is that poised for a rise from that point, so this call was very accurate. I have a whole bunch of other time-stamped stock market predictions that I'll go over in other videos, but this is just one, and the reason I'm citing this one, which is in the description box below so you can look at it as well, is that now we're entering a reversal of this particular barbell, let's call it, the other side of the barbell. So almost 2 years later, 23 months later to be almost exact, we are going to see virtually the reverse. So I come back to this chart over here, which is the S&P 500, and let me hide my face. The S&P 500 has been on a tear in proportion to QE. And remember, QE is not just done by the United States. It's a worldwide metric. So it's hard to judge exactly what the correlation is. But the market sentiment is still very driven by what the US Federal Reserve does because they don't take a worldwide view in aggregate quite yet. And this is what's known as a head and shoulders pattern, in that you have one high, an all-time high, a small correction from there. It goes to another high that stays there for a while. So a head, so to speak, falls and retests the same low, the neckline as they call it. And now you have another shoulder that is not getting back to the new all-time highs, but is kind of hitting the top of the first shoulder as well. So you have this head and shoulders pattern. One shoulder, the head, and shoulder next to it. It's not always going to be symmetrical. The amount of time you have before a crash is not always the same width of the first shoulder or anything. A shock event can make the crash happen sooner, or it can meander for a little bit later, but always be wary that don't think that you have a month or so before it's going to happen. So this is already manifesting itself, a head and shoulders pattern. This is a 1-year chart. Take a 5-year chart, and this is the S&P 500. This was that shoulder, head, and second shoulder, and this was when I made that call about one of the best entry points, and the stock market doubled from that point. Just looking at the trend over here, even though we're getting into an exponential gradient of accelerating growth, the crash from this point could go all the way down to 3,000 or so, and one should not be surprised by a crash from current levels down to 3,000, which would be about a 30% crash from the levels of today, February 13, 2022. So 30% crash from even today's level. Not the all-time high, we're already a fair bit below that, but down to this level. And this level would not seem low under this trend line. If you told someone in 2019 that by in 2022 it would still be around 3,000, then yeah, okay, it's still kind of gently going upwards. This is what happens when the Federal Reserve turns things on in a big way and then turns them off in a big way, causing all kinds of disruptions and market entropy when they should be doing a gradual, steady flow of the atom dues, but that's a topic for another video. So the head and shoulders pattern is factor number 1 to look at. Now we go to factor number 2. This is an obscure economic measure known as the Wu-Jia shadow rate, and it's done by 2 people that you've never heard about, and very few people even know about this or look at it, but it is an approximation of quantitative easing's effect on simulating a negative Fed funds rate, because the Fed funds rate can only be lowered to 0, but then quantitative easing was done to simulate the effect of a negative Fed funds rate. We had a positive Fed funds rate all the way until 2009 when quantitative easing began. And now this green line has diverged from the blue line, because the blue line is the official Fed funds rate and the green line is the additional negative reduction from quantitative easing. The green line is never above the blue line, but it is below the blue line when the US is doing quantitative easing. Now again, this is a US only metric. It does not take into account the worldwide quantitative easing effect, because the US only does 25% of the entire world's total, as I speak about virtually every month. The most recent month is in this video up here. Now look at how steep of a rise this is in the Wuxia shadow rate. We had the quantitative easing due to COVID-19, and that still only got us to this minus 2% or so Wuxia shadow rate. So not even the all-time low that we saw in 2014, but only a partial low. I believe the broader long-term trend is negative because of the exponential deflationary effect of the atom. So the amount of QE that should be done should put us at minus 3% or so just as an equilibrium. Yet the Federal Reserve is tightening. They are tapering their QE very, very fast. And they are about to raise the Fed funds rate. They're going to raise it in March, and then they're going to raise it after that until there's a big stock market crash when they're forced to do QE again. They just don't understand that they're never going to get to this 3% Fed funds rate that they consider to be normal. They still talk about normalizing rates. I criticize that outdated ideological belief system in this video up here that you can look at from about a month ago. But they are tightening when they should be respecting this downward trend. There's an old saying of don't fight the Fed, and I agree with it. When the Fed is tightening, expect a stock market crash. That head and shoulders pattern is already forming. But at the same time, the Fed is fighting nature. They're fighting the first principles of the universe, the principles of the connection between technology and economics, because they're tightening again. And every time the Wuxia shadow rate got too high, there was a large market crash, and they just had to print more. They keep thinking that they're done with quantitative easing forever, and they can raise the Fed funds rate to 3%, when no, they're going to be forced to go lower and respect this downward trend that is very evident and manifesting. Quantitative easing began when it did because a 0% Fed funds rate was kind of normal. This trend goes back all the way to 1990. And this is the very beginnings of sufficient technological diffusion in the economy as to create a high-tech component that was distorting traditional stats. Now, economics textbooks are still decades behind the times, so they can't figure this out. That's why they're tightening. They should not be tightening at all. Whatever inflation they see is because of governmental mismanagement. It is not because of monetary policy, yet they are clamping down monetary policy because of governmental mismanagement, causing a stock market crash, causing a recession, and that will not improve governmental mismanagement at all unless people organize and start to take more political action in a way that forces governmental accountability. And that could take a long time. So now you see this really sharp upward spike in the Wuxia shadow rate. That is a much faster taper and tightening than has ever been done before. Even this large tightening, which they of course had to reverse from 2015 onwards, that caused two market crashes, 2015 and 2018, and a very slow market period between those 2 years. But now they're tightening even steeper than before and about to go positive. And they think, like I said, that they'll go all the way up to 3%. I don't think the stock market and the economy will let them go that high. But this is another big indicator of market crashes being imminent in the not too distant future. And whether it is tomorrow or whether it's 3 months from now, we don't know. But as I've said in other videos, at some point between this February and August window, and the rate at which they're tightening could be within the sooner part of that period. So when you consider this Wuxia shadow rate rising rapidly, an artificial action that is going against the first principles of nature, and that head and shoulders pattern that we're seeing in the S&P 500, those are two of the big indicators to look at. Now, again, no indicators are 100% perfect, and I'm not telling you what to do. This is only so that you can look at various indicators to help you form your own conclusions. I'm not responsible for anything you did or didn't do, or any trade you made or any trade you did not make, because this video is going to be useful even years from now, because I want it to be instructional about when to look for these things. I don't want people to necessarily do something tactical short term that you weren't otherwise going to do unless you have come to your own conclusions. And even after the market crash, this video will be of an evergreen nature for instructional purposes. But the date of this video is important because we're looking at the market charts and the Wuxia shadow rates of this time. So you go back to the stock market chart. That is as distinct of a head and shoulders pattern as you might ever see, especially given the extent of the run-up. Yes, tech company earnings have risen a lot, but a lot of that was because of the Federal Reserve money printing as well, which is being clamped down. So just keep in mind the long-term trend line. Yes, it's exponential. The stock market average returns of 8 or 9 or 10% that were expected in the late 20th century. Over the course of the 21st century, it's going to be much higher than that because of the exponential rate of growth. That doesn't mean there aren't times when things are well above the trend line, such as now, as well as well below the trend line, such as in March 2020 when I made that call about this is probably the best entry point many of us will see in our lifetimes. So these are some important factors to think about. And also, if you have a long-term investment strategy, doesn't mean you liquidate everything either. I'm not suggesting that either. And if you do that and regret it, please don't attribute that to me. This is just something to think about based on where you are in life, what your investment strategy is, and what your investing horizon is. If your investing horizon is more than 5 or 6 years, perhaps do nothing. Those are also things to consider. But these are two indicators that have portended to large crashes in the past, and both are lining up in a very classical fashion at the same time. That is the main point that I'm trying to get across. Now, if you found this video to be informative and you'd like to see more videos like this one, then I encourage you to subscribe to this channel, hit the like button, and hit the bell notification button as well. Thank you very much for watching.